Hello there, this is the final part of lecture series 15 on IFRS 13 Fair Value Measurement. IFRS 13 introduces a three-level fair value hierarchy with level 1 inputs being quoted prices in active markets for identical assets or liabilities that the entity can access at measurement date. The quoted price in active market for an identical asset or liability provides the most reliable evidence of fair value and therefore should be used without adjustment whenever possible. Level 2 inputs are inputs other than quoted price included within level 1 that are observable for asset or liability either directly or indirectly. This may include 1. Quoted prices for similar assets in active markets. 2. Quoted prices for identical or similar assets or liabilities in less active markets. 3. Observable inputs other than quoted prices for an asset or liability, for example, interest rates. Level 3 inputs are unobservable inputs for the asset or liability. This could include cash or profit forecasts using an entity's own data. Please note a significant adjustment to level 2 inputs will lead to it being categorized as level 3. Level 1 inputs are given the highest priority and level 3 are given the lowest priority. Next, let's look at fair value measurement of non-financial assets. These include property, plant and equipment and intangible assets. The fair value measurement of a non-financial asset takes into account a market participant's ability to generate economic benefit by using the asset in its highest and best use, resulting in the maximum value to market participants from either the use of the asset on a standalone basis or in combination with other assets and liabilities. The highest and best use of a non-financial asset shall take into account uses that are physically possible, legally permissible, and financially feasible. Therefore, when assessing alternative uses, an entity should consider the physical characteristics of the asset, any legal restrictions on its use, and if value generated provides adequate investment return to market participants. Finally, looking at disclosures. IFRS 13 includes enhanced disclosure requirements. These include 1. Information about the hierarchy level into which the fair value measurements fall. 2. Amount and reasons for any transfers between level 1 and 2, as well as accounting policy for determining when transfers between levels are deemed to have occurred. Transfers into and out of each level shall be disclosed separately. 3. Methods and inputs to fair value measurements. 4. Changes in valuation techniques. And 5. Additional disclosures for level 3 measurements that include reconciliation of opening and closing balances, quantitative information about unobservable inputs, and assumptions used. These disclosure requirements is to help users of financial statements assess both the following. 1. For assets and liabilities measured at fair value on a recurring or non-recurring basis in the statement of financial position after initial recognition, the valuation techniques and inputs used to develop those measurements. 2. For recurring fair value measurements using significant unobservable inputs, the effect of the measurements on profit or loss and other comprehensive income for the period. This concludes lecture series 15 on IFRS 13 fair value measurement, covering the following areas: objective of IFRS 13, definition of fair value, analyzing in depth the terminologies used in the definition, the valuation approaches available when measuring fair value, measurement inputs and the three-level hierarchy of IFRS 13, fair value measurement of non-financial assets, and finally disclosure. The next bite-sized corporate reporting lecture series will focus on IFRS 8 operating segments. Till my next lecture series, thank you and have a pleasant day.